More on this critical Fed decision. Want to bring in former Boston Fed President Eric Rosengren. He's now a visiting scholar at MIT's Gallup Center. Good morning. Eric, it's the question we're all trying to figure out, and we'll ask, what do you think the Fed will do, and what do you think the Fed should do?
I think it's a difficult decision for the Fed. As many of your speakers have highlighted, inflation is too high. But on the other hand, there's a lot of uncertainty as a result of the financial turmoil that we have. Arguing for actually raising interest rate is clearly that if they want to get inflation down to 2% over a reasonable period of time, they're going to have to keep raising rates unless something else happens. But in this case, something else has happened, and that is the turmoil with the banks. And that creates two challenges. One challenge is we don't really know the extent of the problem at this point. We know that there are several regional banks that have either closed or are having significant problems. But there are probably other financial intermediaries similarly situated and weren't well positioned for how quickly interest rates went up. So I think one of the concerns is that we don't really see all the problems that may occur. The second issue is that we care about financial intermediaries because they provide credit to the economy. And it's unclear at this point, and it'll be unclear for a little while, how much the economy is going to slow down. So in the past, the Fed has tended to try to take it easy around times of financial instability. And so my own view would be that it should follow the policies that it has in the past. I think if they pause and they find out that the financial turmoil dies down, they can always raise rates a little more quickly in following meetings. But if they raise rates and financial turmoil becomes substantially more significant, it is going to look a little bit awkward that they were raising into that financial turmoil.
So, Eric, that's what you think should happen. What do you think will happen?
So the markets are saying they're likely to raise by 25 basis points. I think actually that the risk management argument in the end will be the argument that wins the day.
Meaning they won't. Meaning they won't do it.
Meaning that they'll pause, but they'll pause with language that makes it very clear that if the turmoil gets resolved and inflation continues to be a problem, they will quickly go back on track to raising rates.
And do you think either changes, meaning some people say, you could say we're going 25 basis points, and by the way, then after this we're pausing and we're going to see where we are, or we're going to be at, we're not going to do anything, but we may do 25 in the future, right? How different are those two things? I mean, one actually is a difference, I know, but in terms of the perception in the marketplace.
Well, in terms of inflation, whether you tighten by 25 basis points at this meeting or tighten more at future meetings, no econometric model is going to say there's a difference for the inflation path. But on the other hand, if you tighten into financial turmoil and you make the situation much worse, that's something you just don't know. Part of the problems with financial instability is there's so much uncertainty that it's very difficult to quantify.